Hey everybody, welcome to the morning market briefing. It's Thursday, March 19th, 2026. Hope you're doing well out there. As a reminder, April 1st, 12:30, come get a free bite to eat and learn more about the Jacobs Ladder Group. If you're not local or you can't make it, go to the jacobsladdergroup.org. Learn more about this great organization. Listen to our long form podcast with Amy that founded the group. And if you feel so inclined, click the button on their website, top right. You can donate and support their cause and the great work that they're doing. Ben, Tom, how we doing?
Feeling strong. Big day.
I just reverse aged.
Oh, yeah?
Yeah, according to Garmin, I just got a notification as we were coming onto the call that my fitness age decreased.
Let's go.
22, 23?
27.
Wow.
Wow, that's insane.
I don't even want to try one of those.
I don't want to share mine. It's not great, I'll tell you that.
68.
But I only had two out of range warnings on my sleep last night, so that was a pretty good night. So
Yeah.
Ben, let's jump in. High level, you alluded to this yesterday, thinking that, hey, maybe we're closer to the end of this thing. As you think about the market and the impact, what's top of mind as you think of the Iran conflict potentially winding down?
Yeah. So first of all, I just, I get this sense, and Tom and I talked about this yesterday, that there's this distinct lack of conviction and heightened sense of apathy, both in the U.S. and just in the news that I'm reading and in the markets, toward anything right now. And so I think sometimes the best tack that you can make in terms of is not going one way or the other when you have these times of low conviction, but it's actually to have some conviction. So I'm going to try to have some conviction on this call. And that is I'm more bullish. And here's why. So first of all, I'm looking at what the market's telling me. And the VIX index, which is a measure of what people are paying for options or protection, is actually surprisingly low, given everything that's going on. We're at a VIX level of 25. This is about where we were in November. Yep. And if you think back to November and what was going on, you're like,
government
what was going on? Yeah. And it's like, but people didn't really care. I feel like people weren't really super concerned about that. And so that's what was taking place in November. And so you were at 25. The MOVE index, which is a measure of bond volatility, is only 81.3, which is lower than the 100 level that it was for most of the last few years. And it's been on a downtrend all the way down to 60 and popped up to 80. But 80 is pretty low historically. I know Ryan gives us the historical number every week, Tom, but for the life of me, can't remember that.
It was higher on Monday. It was 91 on Monday. It's come down quite a bit.
So so that's come down even while kind of the stock market has been a little bit gyrating.
Yeah, so the move is a little bit different where you basically divide it by 16, and that's going to be what it estimates your daily average move is going to be over the next 16 days. And so that implies it'll be lower. That being said, we're seeing a little volatility on bonds this morning. We got the only information we've gotten since I walked in the door is initial jobless claims, which came in a little bit under expectation, but should not be moving the bond market as much. But we're at a 431 on the 10-year, which I think is a screaming buy. Interestingly, the 30-year is only at a 490, which is pretty much where it was yesterday. I don't know if any news has come out in the last 5 minutes, but I'm going to dig in on Twitter and see if something did, because that's a big move. We were basically
take a look at that. 430 is
smoking.
Not what I was seeing when I put this together. So everything is subject to change here.
Let's throw Ben's convictions out.
So, but I'm going to continue with this because I don't think it changes immediately. But if you look at oil futures, a lot of people talking about the oil price, but we have a chart of oil futures, and I just wanted to explain what backwardation is. Backwardation is when the spot price, so the amount that you pay today for a barrel of oil that gets delivered today, is higher than the futures price. So a future is when you and another party agree to exchange oil for dollars at some point in the future. So you have oil futures going out all the way to September. So, for example, if you're a refiner, if you're an airline, like you say, okay, well, in September I'm going to need 10 million barrels of oil, and I'm going to, or 10,000 barrels of oil, and I'm going to buy them at the current prevailing futures price. And right now that futures price is lower than the spot price. So if you are an airline and you're concerned about oil prices remaining higher for longer because of this quagmire, what you're going to be doing is you're going to say, man, I can get it for $90 and Brent oil is at $110 right now. I'm going to just lock this in right now at 90 and be good. And I don't have to worry about it in September. And you're not seeing that. So the people who are actually putting real money into this are saying, I'm not
90's probably too high for September. That's what they're saying.
Yeah. And they're saying, I'm not, at the very least, I'm not worried about it.
Yep.
And what I am worried about is getting oil now. And we all know why that's the case. But if you're looking at oil futures, when you're seeing massive backwardation like this, it'll always be backwardated during a war, but this is massively backwardated. So that's what I'm seeing as well. That's what the market's telling me. And also the market internals yesterday, momentum and growth stocks outperformed quality and low volatility. Low volatility stocks underperformed on a down day. That does not make sense. And what we're seeing is correlations go to 1. This happens when you're doing fire sales, when hedge funds go out of business, every trade unwinds. Only 16% of stocks were up yesterday, which a lot of people would say this is really bad breath because all stocks are down. That's really bad. I see it as capitulation.
Yep.
And I see it potentially as, if I'm Iran, I'm trying to hit the U.S. where it hurts, and where it hurts is higher oil prices and the stock market. And so we saw a lot of selling pressure come in toward the close yesterday, and I think they are saying, hey, let's bet against the U.S. stock market and try to hit it. I don't know that, but if I was Iran, that's what I'd be doing. And so I think that you're seeing the market internals a little bit more capitulatory, and then just kind of inferring. So there's this process called Bayesian inference, and essentially that's when you just look around at what you can observe and then postulate what are the most likely causal factors for that. And one is Iran looks increasingly desperate, and then I couple that with U.S. bringing Marines in and devastating a lot of the missile launching systems, and I say Iran is probably desperate because they're losing.
Yeah.
Iran also has a distinct lack of leadership currently because they're all dead. And therefore, I mean, it would make sense that the people who are acting out of desperation don't have as much strategy involved and are just trying to do anything that they can think of in order to survive. And I think that that's the most logical outcome. And you're starting to see other U.S. partners who weren't involved in the early stages of the war now come in because I think they have a lot more confidence that the war is going to go well. And that's NATO was talking about it yesterday, and even this, and then France started talking about it, Germany started talking about it, and even just a couple minutes ago, Keir Starmer, the UK, who is so adamantly against coming in.
Keir, I barely know her.
Is setting up the argument to intervene as well. He said that he condemns in the strongest possible terms Iran's hit on the Qatari LNG facility. So put all that together, and I think that the war effort for the U.S. is going well. I think the Strait of Hormuz will open, and I think oil prices will go down and the markets will resolve. But you're not seeing that conviction in markets, and I think that that's the opportunity.
The only news I can see that may have come out in the last few minutes. So the Bank of England met this morning. They voted 9-0, which is unusual, to hold rates steady. Obviously, inflation in the UK has ticked up recently, and they're a little bit on high alert. But the press conference is going on, and Andrew Bailey said, quote, the Bank of England is ready to respond to the risk of a more persistent effect on UK CPI inflation, which the market seems to be indicating that there may be potential hikes coming from the UK this year, which is a possibility to affect global rates. If obviously, I mean, historically speaking, you'd see a lot more divergence between UK gilts and the 10-year bond. And recently the gilt has been trading above the 10-year, which, I mean, I even said it probably, a week ago, Ben? I was like, hey, how do we buy British gilts? Because if you buy a higher yielding security and you have a declining currency, say the pound sterling strengthens against the dollar, then in theory you would get even more pound sterlings per your dollar of yield over time. But that's going to move the whole stack. So if they're potentially going to hike rates, then that creates a global change in where rates are settling, and that's my That's my feeling as to what's happened, because otherwise there's not much going on. I mean, oil is up this morning, but
it hasn't moved.
Yeah, it hasn't moved in the last. Yeah, in
Yeah.
fact, it's actually down from where it was at like 4 o'clock in the morning. It was at like $117 a barrel on Brent, and now it's like 113. So that wouldn't have affected yields so much in the last 10 minutes. But that's my only thought, is that they're doing the press conference and the hikes may be on the table for Bank of England, which does affect global currencies and interest rates.
And you're seeing global liquidation of everything. I know that a lot of clients have been wondering about investing in gold or silver or any of these things. Well, gold is down 6% this morning. Silver's down 12%. So I think you're just seeing a lot of areas just absolutely liquidate things. And I wouldn't rule out the Chinese from selling some of their gold too. This is a country that obviously needs Iranian oil, and the prospect of the U.S. potentially taking Karg Island, which exports 90% of Iran's oil, would be devastating for the Chinese. If I'm China, I'm calling up Trump. I'm calling up my Iranian friends and saying, look, guys,
We got to make a deal.
we got to make a deal, because we're going to completely throw you, Iran, under the bus.
How does Iran make a deal with such a void in leadership? Like, who's making the deal? I mean, I think that creates an additional element of uncertainty. I mean, there is an element to me. I'm very concretely of the viewpoint that regardless of the intention behind the war, regardless of the objectives, regardless of the final outcome, there's no chance this thing has been even. But I also, by the same note, wonder if there's a cooler head who is the clear leader in this situation, are talks already happening, but there's not.
Yeah, how does a Chinese leader, who do they call at this point? Do they even know who to call? I mean, that's the wild thing.
I think that's an element of uncertainty. And then I do wonder, like, when this thing does resolve, you mentioned the apathy, like, do people care?
There's a great this guy Alex Berenson. He was
blacklisted hard.
He was blacklisted hard. He got banned from Twitter for suggesting that the COVID vaccines may cause myocarditis in children. And I want to say he was either Wall Street Journal or New York Times, but he basically got fired from that job. But he has a Substack where he's been covering a lot of this. And I think he's actually a very smart guy. But he was basically saying that we've gone back to almost a 1600s or earlier type of warfare. We used to be, King George used to ride out of his castle and go fight King whatever from France. And if one of them died, then the other guy won. And over time, we slowly moved away from that model where those who were in charge were moved further and further and further away from the front lines. And the last general to die from gunfire for the U.S. was in Vietnam. But we've switched back the entire way, which is we've never been in a scenario where one country had so much more power and surveillance power to suddenly just systematically grind the top of the pyramid down until we eventually get to someone who could make a decision that was going to be amenable to the changes that were going to and are going to happen to Iran. So it was a really interesting take on it. He's like, I don't know how this ends up. He's like, but this is an unprecedented place to be because we just haven't, it's not Stonewall Jackson getting hit in the chest with a cannonball. It's everyone's so far away from the front line. Yeah, it's like you're basically going top down and not bottom up. And so it's just an interesting take. I mean, it's something, certainly an interesting think piece on like what exactly is going to happen here. And I don't know, but what I can tell you is that it's not going well for Iran, despite what you would read in the newspaper. I mean, what is China going to do? If they need to call somebody, who do they call? Like, they can't rectify this situation even on their own behalf. Like, they've, it's an atheist country. I mean, how are you supposed to channel the Ayatollah and ask him how to make this work because he's, taking a celestial dirt nap, I mean, it causes a lot of problems that we don't have an answer for because this has never happened.
I mean, it's going to be fascinating to see it play out. I continue to wonder if the 4 to 5 week time frame is not exactly where we end up on all this stuff.
I'm definitely coming more around to that.
We would be at the halfway point, basically. What are we seeing from companies? Micron down 5%, Ben.
Yeah, apathy. The vibes. Are there any vibes left? You kind of asking yourself. Micron. I don't know if you guys like this, but I like this as an analyst and an investor. We don't own Micron shares, but they just came out with fiscal Q2 guidance that puts their revenue up 250 to 270% year over year. The estimate was $23 billion. They're coming in at about $33 billion. Gross margin, the estimate was 72%. They're coming in at 81%.
Makes sense that they'd be down 5%.
EPS, the estimate was $11.29. They came in at $19.
That's insane.
I mean, this is a company that is making a ton of money. A lot of it's coming from pricing, but a lot of it's coming from they're massively supply constrained right now. They think they're going to be supply constrained in NAND flash memory for the foreseeable future. And memory is really viewed as a strategic asset for AI, and the stock's down 5%. So,
if you think about, and you can look this up, and Hicks, I don't know if you want to try and quickly pull it, but there's the market cycle curve, and they show this in every economics class. They show it. It used to come up a lot more, but the top of the curve, when markets are overvalued, you have irrational exuberance, and at the bottom you have capitulation. I'm not seeing irrational exuberance. If NVIDIA was $400 a share, which, if you really think about the type of money they've made over the last few years, they should be. And the fact that Jensen Huang came out and said, we're going to make $1 trillion in revenue, like that should be meteoric for a stock. But everyone looked at it and just went, and that's an indication that people aren't going crazy. I mean, we talked about the baseball card market. You think about the Bitcoin, or what are they called? The apes? I forget. I can't even think of what was the non-fungible tokens, NFTs. People were buying pictures of apes wearing sunglasses for millions of dollars a piece. Like, that's not happening. But when that was happening was at the end of 21, beginning of 22, when it was just like, this market's going to go on forever. And no one thought that there was going to be a war that started in Ukraine that would cause the market to be down 22% and cause rates to go from 0 to 5. And I think that's the difference, is if everybody's looking for the enemy to come over the wall, then he's not coming. But if you're just hanging out, high-fiving everybody and talking about how the world's never going to end and we have no enemies, that's when the Genghis Khan comes over the hill and just slaughters your entire, civilization. So I think that's something to think about. We're not at a peak. If you walk around everyone and say, hey, how are things right now? The answer is not like, man,
awesome,
the best it's ever been. Like the housing market feels gross. The stock market feels gross. There are plenty of companies that are making a ton of money, but nobody's interested. Nobody's like, man, if I buy this now, I'm going to make a ton of money. They actually think the opposite, which is probably a good indicator that we're not going to have a massive pullback. I mean, we have a correction. We may go down 10%. I mean, that's certainly possible. But eventually people are going to look around and be like, hey, I don't know if you guys know this, but NVIDIA is going to make $1 trillion next year, and it's lower than it was 6 months ago.
The risk aversion is always going to mean that we have more conversations that center on what could go wrong versus what could go right. But I think that ratio is about off the charts for a market that's down 3%. Like when it's down 20%, it's like, man, is it going to be 2008? We have a lot of those conversations. Although we did not have that actually after Liberation Day yet.
I mean, it's not dissimilar to me, though. Like, I just remember 2020 when you had the massive market correction and just the absolute cratering in March. Then clients tuned out, and they were just absolutely shocked, and I'm not calling clients out, but I mean, it was such a fatiguing news cycle, and then they were just absolutely stunned January of 21 when we're having a review meeting, and we're like, yeah, your accounts are up double digits. I mean, they couldn't believe it. I mean, people legitimately questioning the returns, being like, I thought it was a horrible year. This is a similar disconnect to me in which clients, for different reasons, I think, but are pretty floored that their balanced portfolio is down a little.
Roughly flat, depending on,
yeah.
It depends on your mix, obviously, but.
Yeah, and especially today with bonds getting hit, that's not going to be great. But, but I mean, I would I completely agree. And even if just putting Iran aside, which I know is tough, but how many conversations just with AI are about, well, what are the risks of AI? Like, should we sell out of stocks because of AI? Not like, what are the opportunities? It's all about what could go wrong because of AI. There's nothing what could go right because of AI. And I think that, having a little bit more balance in those ratios would be a little bit more indication of bullishness for us. But
It's
but right now
certainly going all one way.
And frankly, you know, our clients I think are a little bit more sophisticated just in terms of we try to educate over a period of time and
just because we're so sophisticated, obviously.
But
Birds of a feather.
But our clients
You are the average of the 3 people you listen to on a podcast every morning at 8:30.
But our clients are pretty long term in
It's a really weird individual.
Higgs. But our clients are pretty long term natured in thinking. If you look on Twitter or what other financial people are talking about, it is even more extreme than the conversations that we're having.
Yep.
And so I think this is...
and it's hard for people not to internalize that.
Yes.
But if you had a 50-50 portfolio right now, you'd be down 1.5%. If you exactly market performed, so the stock market is down 3% almost on the dot year to date. The bond market is up 0.03% on the dot year to date. So if you put a 50-50 portfolio, you're down 1.5%. If you got exact performance. Now our performance has been, you know, knock on wood, pretty good this year on the equity side and the fixed income side. And so, like, you know, say the average account is down 1%. That's not the end of the world.
That's just not a big move over the course of 3 months.
Especially when the market was up, call it, 16% last year, and then we had bonds up.
And this is really
high single
simplistic,
digits.
but let's use that 1.5% number. I would not be getting, and I think this illustrates the point, I would not be having conversations in the general community or with clients who would be doing backflips in celebration of being up 1.5% through 2.5 months. And that's the imbalance. And I say that again, not to be luxurious, but rather just say, like, hey, let's all stay calm here. Darden down 1%.
Same
despite
story.
Again, great numbers. Longhorn comps up 7%. Longhorn is back. Federal Reserve yesterday, Tom.
I will say I had to educate the young boys the other day on the big-haired lady, the namesake of the Flo's Filet. There used to be some. Look them up. The commercials are actually
Awesome,
very funny. But there used to be a spokesperson for Longhorn Steakhouse that was the big-haired lady. But it seems like the most dated thing on the planet now if you watch it. But that was a big advertising campaign back in the day. Fed meeting yesterday. I would honestly say it came out slightly more dovish than I thought it would be. I thought Jay Powell was really going to do a victory lap. But if you looked at the dot plot.
I bet he wants a do-over now that he knows Bank of England might raise.
Yeah, exactly. And it came in, there was one dissenter. It was Stephen Moran. So there's notably still some, a little bit of a shakeup there at the Fed. But notable takeaways is that the dot plot shows that they still expect 1 cut this year. I would say it's either going to be 0 cuts or significantly more than 1. And I would be on the side of, as always, at least so far this year, I would say 2, maybe 3 cuts. But Jay Powell basically used the cover of the lawsuit about the overspend on the Fed Reserve building to say that he is not going to exit the Fed until that investigation and potential prosecution is done. So Jay Powell is still in. I think that's the indication we should take on that. So that adds a little bit of an interesting piece to it. The question is, how quickly does that happen? He's going to stay on, obviously, until Kevin Warsh is confirmed. That is the process.
He's putting the Trump in the ultimate.
He's flipping it on him.
Would you rather me off the Fed or maybe me in jail?
Yeah. Well, the problem is, if Powell doesn't step down off the Fed, what spot is? I guess Warsh fills Moran's spot.
Yeah, so I think they've already filed paperwork for Warsh to take Moran's spot. So he's going to exit. Warsh is going to come in, and then Jay Powell will, I guess, just drop back down onto the board. But I mean, he's using the investigation against Trump, which is shrewd. But he's trying to be a hero.
It's the only thing he has any conviction in.
Yeah.
Because the rest of the
well,
talk.
We'll see. He might have another, am I right? That's a little conviction humor for you.
The rest of the discussion was all about how he has no idea.
They have no idea what's going to happen.
I mean, he, like, with all due respect, he looked
stupid,
old, tired, worn out.
Terrible posture.
And like his time had kind of passed him by.
He's mad-owing a little bit too. He's changed his frames.
Yep.
We got to keep it. You got to monitor people's frames.
Yeah, I walked in. I was like, "What's Mark Cuban doing?"
Yeah.
Didn't
dye his hair today.
On the dot plot, he said people are, just writing down what seems to make sense to them, but with no conviction. We just don't know. I wouldn't say there's conviction. You just have to write something down. This is how we're making monetary policy. This is how we determine the price of money. The Federal Reserve said we're not going to let the market determine the price of money. We're going to determine the price of money, and we're going to have no conviction in it.
There's a place for humility, and there's a place for a meager representation of your thoughts. But it's the like I want a head coach who comes out and says, this is the game plan, this is what we're going to do. And when they do that and it doesn't work, they say, I was wrong. I didn't have my guys ready. We didn't execute. That's on me.
Yeah,
I don't want one that comes out and says, you know what?
We're going to put Tua in.
This team's really good. I'm not sure what to do about it.
Sometimes you got to make halftime adjustments. Yeah. Sometimes you got to put the backup quarterback in. And you know what? It might be the right move, and you might have started out wrong.
Yeah.
I
mean, that's the reality. But it's the lack of hiding behind a lack of conviction when you are the leader of monetary policy does not sit well with me.
In the most powerful central bank in the world.
I would much rather you have incorrect convictions.
If I have an analyst come to me and I ask him, hey, what's your opinion on Micron? And they follow Micron and they say, could go up, might also go down. I just don't have any conviction in it. Then what are we paying?
I mean, we do it even in-house all the time. We haven't had it as much lately, but gun to your head, would you buy or sell this stock? Oh, I'd hold it. No, that's not an option. We need conviction. We're leaning on your decision making. We are not expecting that you're going to be right all the time, but you have to have an opinion.
Big gun to your head guy.
Yeah.
Love a little, especially with the young boys.
We bring Hicks in there.
Yeah. Hicks will actually hold a gun to your head.
Yeah.
Stone cold killer.
Yeah. The best, Hicks will get gun to one guy's head, and then we'll be like, what about you? And Hicks pulls out another gun.
Shoots the first guy.
We are going to get blacklisted by YouTube so fast on this one.
Yeah. The dot plot. So what was in the dot plot was they took the GDP numbers higher, and they took the inflation numbers higher, which was interesting to me because they also took the core inflation, which strips out energy prices,
down.
So they took that. No, they took that up.
Oh, they took that one up. I thought they took that one down.
No, they took that up. So they took that up even though it has nothing to do with energy. In fact, higher energy prices should actually make the rest of the bucket go down because people don't have money to spend on that stuff. So higher GDP,
based
higher
on
inflation, so a lot higher nominal growth, same employment number.
Which is an insane interpretation, him talking about the steadiness of the unemployment rate.
Yeah.
So what are we doing?
And we have a chart on that too. And then he also...
he talked about the ratio of... He was talking about the unemployment rate. He's like, well, we're actually having so many people be deported and lower net immigration. He's like, so you really got to look at the ratio. But if you look at the ratio, it's actually is good. Counter to his point.
Let's pull that up, Hicks. We'll talk about the employment number divided by the total population in the United States currently. And it's
not a favorable
it's straight
picture.
Down.
Yeah, it shows that unemployment is actually getting significantly worse. Man, that is little. There we go. We got it sized up. So this is Jay Powell's chart showing how good inflation is if you look at the ratio.
How good employment.
So typically, if that was your portfolio and I said we're just really crushing it right now, it's gone from way up here and we're just slowly grinding down and to the right. I don't think that you'd walk away from that meeting being like, these guys are doing a good job.
Yeah.
It's what if I told you I had $100, but we actually over the last couple of years, we've gotten you down to 75.
Yeah.
The ratio of how much money you have versus how much money you started with is actually very favorable.
It's crazy.
Yeah.
I thought it was a weak press conference.
Ben's rooting for a down day today for the opportunity. Tom, what are you watching?
We're going to be buying bonds today. It's especially in the middle section because we've been sort of avoiding the 10-year range because it's been so overbought, and there's value either on, call it short credit bonds or long high credit quality bonds. But right now, the fat middle is where all the selling is. The 2-year and the 10-year have underperformed the 30-year in the last 30 days, and that's opportunistic, I think, to kind of fill in the middle of that gap. We've been doing a lot of, I'd call it U-shaped portfolios, where you've got a lot of bonds on the front end, a lot of bonds on the back end, and the average is sort of the middle, but you're getting a much higher yield. Now it's time to fill in some of those middle tenors and rock and roll.
Get a a square root shape.
Mm-hmm. Yep. There's a name for that, right?
Yeah. All right. We'll wrap it up there. Talk to you soon.